Almost everyone has been warning about impending inflation in recent months. Ray Dalio, Michael Burry, Warren Buffett, and even consumers throughout the world have seen inflation begin to rise in almost all commodities and services. Furthermore, the majority of investors expect that inflation will continue to climb significantly in the future. Cathie Wood, a typical contrarian, believes that the reverse will occur: deflation. Cathie believes that the real black swan occurrence is a deflationary catastrophe rather than an inflationary crash. Welcome to the Investing Wise Academy, a channel where aspiring millionaires and billionaires can learn how to invest wisely. In this video, we will go in depth on why Cathie believes this and how data backs up her claims. If you're new to our channel, please subscribe to see more videos like this. Let's get started. Cathie Wood began her career as an economist and can back up her statements with decades of experience. As a result, it's critical that we listen to Cathie without any previous assumptions. In fact, two notable economists, Henry Kaufman and Milton Friedman, believed that inflation was here to stay in the early 1980s. Cathie Wood, a relatively fresh economist, on the other hand, believed that inflation was slowing. Cathie was correct in the end. Cathie Wood is making a bold prediction against the crowd, which is nothing new for her. The money supply is the first sign that inflation is slowing down. Since the outbreak of the pandemic, the amount of M2 money available has risen dramatically. M2 money is a measure of the United States money supply that comprises savings deposits, checks, cash, checkable deposits, money market funds, and certificates of deposit. As stimulus checks have soared, it's no wonder that M2 money has risen considerably as well. The rate of M2 money growth, on the other hand, is dropping rapidly, according to Cathie Wood. This year's rise in M2 money has dropped from 27% in April to barely 17% in May. Because of the recent downturn in growth, the bond market has seen a significant increase in recent months. After hitting a high of 1.7% in March, 10-year government bond yields have fallen to around 1.5%. Inverse correlation between bond yields and bond prices suggests that the bond market has been rising as yields have fallen. For example, the bond market predicts deflation rather than inflation when this occurs. Bond prices may be rising due to an increase in money supply, Cathie Wood claims. By a factor of 2, the money growth rate has been slashed from 27% to just 13.8%. Bond prices may have been boosted by the Fed's fictitious purchasing power, but that isn't the case. This isn't a new factor in the bond market. The Fed has been buying bonds for months. When the bond yield soared in March, the Fed's buying power was still there, indicating that the central bank's purchasing power has not altered. Aside from selling some corporate bonds and ETFs purchased during the pandemic, the Fed had planned to sell some corporate bonds and ETFs it had purchased. It was Cathie Wood's belief that the bond market would decline. Nonetheless, bonds have continued to rise. PPI is substantially higher than projected, as Cathie Wood indicated with the CPI statistics that they have received. She also stated that she would have expected the bond market to continue to fall and interest rates to rise as a result. The 10-year Treasury bond yield has fallen from 1.74 to 1.43 since the end of March. Regardless of how solid the economic data has been or how high the inflation figures have been, she also stated that many people may claim it's just quantitative easing, which she believes was true at the start of this year and through March when they went from 0.9 to 1.74. But according to her, the bond market is on the lookout for something. Cathie Wood may appear insane, but she expects inflation to persist for the next few months. According to the Personal Consumption Expenditures Price Index, prices rose by 1.6% year-over-year in February to reach 3.9%. Cathie believes that this inflation rate could reach 5% in the month of May. Cathie anticipates a long-term decline in prices, notwithstanding the possibility that inflation would accelerate over the next couple of months. Ironically, the spike in oil prices is paving the way for deflation. The Organization of Petroleum Exporting Countries, or OPEC, a collection of countries that controls the oil supply, is determined to regain some earnings by limiting oil production. As oil prices have risen, this may appear to be counterintuitive. Increasing numbers of individuals are opting for electric vehicles. During the pandemic, EV sales have grown disproportionately to those of vehicles powered by fossil fuels. This is influenced in part by rising gas prices and the perception that electric vehicles are preferable than gas-powered automobiles. If oil costs continue to rise, more people will be incentivized to purchase electric vehicles, reducing the long-term need for oil. Current crude oil prices are approximately $75 per barrel, which is close to the recent high of $77. Cathie believes that the price of a barrel of crude oil would eventually fall to between $3 and $12. Indeed, $3 to $12 per barrel. A price of $12 per barrel would represent an 84% decrease from the current pricing. If these low prices materialize, significant deflation would ensue.
One of the reasons is, of course, OPEC, and they have about 5 million barrels they could produce per day. They're not. They want to keep the oil price high enough so they can fund their budgets. But at some point here, they may end up killing demand. When they start seeing demand destruction because of pricing, I do think they'll start producing. And as you know, longer term, the combination of electric and autonomous electric vehicles, we think, is going to drive oil prices down. As I've said, now this is my point of view, we haven't done the research to get us here yet, but I think we could go down, back down to where oil prices landed after the cartel took over in the early 70s. And they went from, I think, $3 a barrel or $4 to $12 a barrel. I wouldn't be surprised ultimately to see us back there, especially as electric vehicles continue to take off, and they are starting to take significant share.
The purchasing power of the US dollar is an additional indicator of deflation. In the past month, the dollar index has dramatically increased. This directly contradicts the fears of dollar inflation, as the dollar is gaining purchasing power relative to other currencies. This could be due to Biden's corporation and capital gains taxes being lower than anticipated. Commodities too have been falling recently. Cathie Wood foresaw the recent decline in lumber prices and forecasted it far in advance of its occurrence. As Cathie points out in the next video, China's pork prices and copper prices are other indicators.
Against, I think, the consensus expectation, the consensus short in terms of currencies was on the dollar at the beginning of this year, and the dollar is not going down. That's also consistent with the bond yields coming down, surprisingly.
The final element to consider is the demand from consumers. Month over month, real consumption decreased by 0.4%. There is a 0.3% month-over-month decline in durable goods consumption and a 0.5% decrease in non-durable goods consumption. But month-over-month consumption of services is up just 0.4%, which is less than the drop in consumption of goods. Consumer spending and money supply growth are both slowing, but inflation may not be as bad as you think. This is supported by the recent drop in commodity prices. Many others, such as Dalio and Burry, contend that the bond market is in a bubble and that hyperinflation is imminent. That's all for today. What are your thoughts on Cathie Wood's warning about deflationary crash? Join the conversation in the comments section below. Please click the like and subscribe buttons if you enjoyed the video. We'll see you in the next one.